Hey everyone, Eric Dutram here with the latest edition of the Dutram Report, the podcast on ETFs and more. Today we have what I'm going to call a Dutecast, where it's just going to be me giving you an update on an in-focus topic. Today's takes a look at Snapchat and how this company being barred from major indexes will have a big impact on investors. So if you have any questions or comments, make sure to send them in to podcast@saks.com, and don't forget to find the Dutram Report on iTunes and give us a review there as well. But stay tuned for my look at Snap right after this. So the focus of this is going to be on the S&P 500 and some of their new rules that they just put in. Now, a lot of people think the S&P 500 just takes the 500 biggest companies out there, but that really isn't the case. The index provider, Standard & Poor's, actually has a couple rules for inclusion besides just being big. For example, you have to have more than 50% of your shares outstanding have to be available for trading, headquarters has to be in the US, and you have to have had at least half a year since the IPO. Now, S&P added another wrinkle to the mix as of late, though, and that is it will exclude new entrants that issue multiple classes of shares. Now, you might be saying, Eric, come on, index construction, who cares about this? But it's actually a very important topic, and here's why. The process has become extremely popular among tech companies lately, including Snapchat. Now, Snap's recent IPO featured shares that don't have any voting rights at all, giving the co-founders, Evan Spiegel and Bobby Murphy, majority control of the company after the IPO. So thanks to this structure, which is basically, let's be honest, a power grab by the Snap co-founders, Snap won't make it into any Standard & Poor's indexes, including the S&P 500, and a variety of other areas where Snap might pick up some exposure, such as, say, an S&P 500 growth index, any other S&P-related tech indexes as well. This could actually be a big issue for Snap investors and really other tech companies down the line too. And it's not just Snap facing these issues as of late though, as we also see this with Blue Apron, albeit in a different way. Now, Blue Apron took the Snap idea and sort of went above and beyond, if you ask me. They actually have 3 classes of stock, and they just had the IPO for its Class A shares as of late. Now, stay with me here. These have 1 vote each, while the Class B shares, which weren't IPO'd, have 10 votes each. Meanwhile, there's still Class C shares, which weren't IPO'd at all either, and these don't have any voting rights at all. So they're really using a mix of different classes here, and we're seeing this structure more and more for companies as the founders try and preserve their control while still being able to cash out at least part of their holdings in an IPO. As you might guess, this keeps control in the hands of a select few, and it makes activist attempts all that much harder, and it arguably makes managers less accountable to shareholders too. After all, if you can't vote on new policies or new people to add to the board of directors, it's going to make it very hard to change things. And that's why the founders and a lot of these companies who do this really like the structure, but others on the outside don't. Now, some might argue that excluding companies like Snap, especially when they're pretty sizable, defeats the whole idea of a broad market index in the first place. And I can see where they're coming from with that. If you're a broad market index, shouldn't you have all the companies in there? But at the same time, this multi-share class is sort of cheating, if you ask me, and I can see why indexes are moving to do what they can to restrict it and keep companies from implementing this on a wide scale. Just so you know, though, some old standbys are going to be just fine, and they're not going to be excluded from the S&P 500 or any of the other Standard & Poor's indexes. And by that, I mean some of the most famous companies out there, including Berkshire Hathaway, Google, and Facebook. All 3 have multiple share classes, and they've all, well, at least Google and Facebook have, done this move in order to preserve control among some of the founders and keep control in certain areas of the company and not offer as many voting rights out there. Don't worry about these guys, though. They're going to be grandfathered in despite their multiple share classes, and the issue of the multiple share classes will only apply to new companies coming in. So, new possible entrants such as Snapchat look to be on the outside for the S&P 500, and this actually follows up an announcement from FTSE Russell in the same vein. Their stipulations were that voting rights among traded shares needed to make up at least 5% of the total votes, so Snap is once again out, but some of the other companies that offer up at least some shares that have voting rights are going to be okay. Now, some might say, who cares what Standard & Poor's or FTSE think, but this has cascading impacts that will likely act as a deterrent to those thinking about doing this in the future. Why do I say that? Well, This is because with the rise of passive indexing and all the money that's flowing into ETFs and mutual funds as of late, getting in these benchmarks is a super easy way to get at least some of your shares mopped up by forced institutional buying. After all, SPY, most popular ETF out there, is by itself $250 billion in assets, so that's a huge pool to get into. And for the entire passive index space, over $3 trillion is invested, including sizable inflows as of late. Let me give you an example. Ulta is a similarly sized company to Snapchat, roughly same market cap, and they're, while not in the same area, they're both kind of growth companies and they're coming in the up and up. And I think it can be used as a decent proxy for weighting in major indexes. Now, in SPY, Ulta makes up roughly 7 basis points of the total fund. Sure, that's basically nothing in the grand scheme of things, but it actually translates into SPY holding 1% of all the Ulta shares out there. Now, several other funds, according to Morningstar.com data, have more than 1% of the ownership too. In fact, the top 20 holding funds by themselves account for a quarter of all the Ulta shares alone. Now, this is a huge percentage, and it's not even the whole amount. Remember, it's just the top 20 holding funds. And it's important to remember many of these funds are forced to buy Ulta, while plenty will not be forced or really even able to buy Snap. And while I'm not saying that Snap and other differently structured stocks are going to miss out on all this forced buying, they will definitely miss out on some, and especially for a few of the most important benchmarks out there, including the S&P 500. So while index providers can't tell companies how to structure their stocks in the future, the impact may more or less force their hands. It's going to be very tough to do an IPO if investors know right off the bat that you're not going to make it into any of these major indexes and that there's really no hope for you to get into the indexes in the future. Now, this is something that Snap investors and those thinking about similar structures in the future definitely going to have to keep in mind. And I think the impact of these indexes will show the importance of getting into the benchmarks, and it's going to force some changes for tech companies and anyone else out there who's thinking about holding control via voting rights shenanigans. Now, ETF and other passive investments are just too big of a pool of money to pass up, and this is only going to be an even bigger issue if current trends continue into the future as well. All right, everyone. Hope you enjoyed this solo Dutram report and my look at the latest news of Snap and the major market indexes like the S&P 500. Make sure to tune in for more interviews and discussions on the world of exchange-traded funds in the future. And for my thoughts on the ETF world, make sure to go on over to Zacks.com, check out the ETF Investor Service, which includes my top picks and commentary on the markets. And don't forget to find and review the Dutram Report on iTunes. And if there are any topics you want us to discuss, feel free to reach out at podcast@Zacks.com, my Twitter page @EricDutram, or leave us a comment over on Facebook too. Be on the lookout for a new edition of the Dutram Report each and every Thursday. But until then, for Zacks.com, I'm Eric Dutram.